And speaking of stop outs, first and foremost, again, you should always place those, with the parameters you and your registered financial representative set forth. I see that people want to go ahead and mimic my stops. Obviously, on this trade, I'll be keeping my stops pretty tight, but nonetheless, you really need to stop out where you feel comfortable. Okay, have that discussion internally with yourself how you're going to go ahead and do this. Typically, from my perspective, for my trading, as I've mentioned on these so far, or up to this point, I've mentioned this to you guys before, that as far as I'm concerned, if the trade moves against me and closes back beyond that 20-period moving average, that's indicative of a stop-out point. Why is that? Well, here's the fast speed line. Here's the slow speed line. Here's the 20-period moving average. Well, I've got this trade going up my way. Okay, appears to be then a new direction is formed. And let's say we get the pullback bar. All right. Well, what I'm expecting then after this pullback bar, okay, that's supposed to be a shaded bar here, is then a continuation, a resumption back in the direction of the trend. Okay. If it turns around and the market actually goes down here, now I've seen it where it does trade below the 20 and then it closes back up. In fact, sometimes those become the strongest trades, don't they? Richard, what kind of trade is that? When we see it, it turns around, it comes down, makes a lower low, comes back up. What do I call that? Or anybody who wants to answer there? That's right. It's a key reversal up back in the direction of the trend. So it's a trend continuation opportunity. So very good, Rick, as well, both of you. So the point is that coming down below, okay, this point, maybe down to a lower speed line or below 20 and then closing back up is a good thing. But to go ahead and have this bar come down and then close down, so now we have this thing all shaded in, that's breaking the spine of this trend. So that, from my perspective, is a stop-out point. That is not what we expected to have happen with this trade. You're looking for because then basically you're violating the fast speed line, the slow speed line, and the 20-period moving average. So 3 areas of strong support did not prove themselves out. Now, yes, after it comes down to here, is it possible that it turns around this next bar and shoots all the way back up? Well, yeah, it is possible that it goes ahead and does that. But so from my perspective, if we close back down below that 20-period moving average, that is not what I expected to have happen. Okay, so from my perspective, I'm looking for the exit. All right. So you go ahead and determine, of course, what you're looking for, but I'm going to go ahead and just keep it close to the vest here. All right. So those are my stop outs, and again, always consult your professional registered representative on that. As you guys know, I don't hold myself out to be a registered financial representative, or give you guys individual trading advice here. You guys get the benefit of seeing what I'm doing with my trading. And then as far as the exit techniques, okay, Paul. Well, I said long until we're wrong today. So as far as the exit techniques here, for a conservative, we're looking on exiting on the close of the next bar post-entry. So let's talk about that for a minute. Okay. So we've got, I'm just going to use the more conservative one, okay, for a moment as the example. Okay, so what you would be looking to do if you took this particular trade, this is a conservative setup to the 2-bar push, and let's say the volume was there, and the volume was light here. If you're just looking to go ahead and be in and out of this market, So basically you're very afraid to be in this market, maybe this because the technique's new to you, more importantly because you don't feel comfortable or don't know how to raise your stops up in that. Now that's another issue. If there are people here that don't know how to move your stops and that kind of stuff, let me know. We'll do a separate training on just doing that, okay? Um, so we'll go ahead and be happy to help you because moving stops, in my opinion, is critical to the success of this trade. You're not going to just want to keep your stop at negative 4 ticks, negative 8 ticks, negative 12 ticks, whatever you use forever. And at some point, as this thing is making money, you're going to want to go ahead and move your stops up. That's at least how I'm going to be trading it. Certainly you do it the way you want to do it and what you and your registered financial representative set forth, but I'm going to be focusing on these here. But for a more conservative person, they may say, you know what, I loved it. I like the fact that it works. I saw the 1 bar pullback. I just decided to go ahead and exit at the end of this trade. I'm not used to this whole moving my stops up thing, so I just killed the trade at the end of the next bar. So whatever bar you enter on. Now, of course, if you're an aggressive, more aggressive trader on this, and I hate to use the word too much aggressive on this because it sounds like a negative connotation, but I guess we'll call it a variation of the technique, is going in, exiting, or entering on the close of this bar. If you have it written in your risk trading plan that you're going to exit on the close of the next bar, then what you may find yourself doing is going in and actually exiting on the pullback bar right before the big move goes ahead and happens. Okay, so keep that in mind as you're developing your risk trading plan on this strategy. You want to factor that in. I know there's a couple of you here that have been working on your risk trading plans, like Charlie. So Charlie, I'm speaking to you on this, for instance. Keep that in mind as you're developing your risk trading plan, that you want to go ahead and focus on, okay, conservative versus more aggressive, versus let's say hyper-aggressive entries, and then what's your exit strategy? Is your intent just to keep letting this thing run up and follow one of these two, or are you going to get out at the close of this next bar? So you're going to want to define that in your risk trading plan. Okay, and let me just take a moment to look at Peter's question here. If you put your stop in below 20 and trades there, your stop is hit whether it turns back up or on the bar or not. If you see what, that's absolutely true, Peter. If you have your stop in place here, what I said was, I talked about the close of this bar. Historically, what I do is, as you guys know, I talk about emergency stops, and I keep my stop a little bit wider there because I have the discipline to make sure I get out of a trade. Unlike many junior traders who just keep moving the stop, moving the stop, moving the stop, it's like, oh, wow, no, now I'm down 5 points. Okay, well, it's got to stop here. I'm going to move it to 6 points. I'm going to move it to 8 points. It's got to stop. It's got to stop. I don't do that. Okay, it's a real junior trader mistake. What I'm typically looking to do then, Peter, is in this kind of situation, I do have my initial stop set to 8 ticks, but what I do then is I evaluate whether the close actually is going to come down here to this distance. What you're talking about is having your stop pre-placed, move it up there so that you're right below here. What I'm saying is if you do that, then you do risk exactly what you said, getting stopped out even if the thing turns around. What I'm saying is, let's say your stop is down here, the 20-period moving average is up here, it closes down below. Even if your stop is way down here, it doesn't matter. You're going ahead and exiting the trade. You're closing the position out on that trade. So I'm not saying go ahead and just blindly move a stop up right below the 20 here. I said that you're looking at it if the market closes below that. So what that means is you have two choices. You can put a fixed stop in there so it's already there before the market even ever comes down to this area, because you may say, because that's an individual thing, Peter, you may go in and say, you know what, if it even comes down to the 20 here, that wasn't even what I expected. I expected this next bar just to open and tear up, or I expected it to go no further than the speed line. So then you may say to yourself, okay, well, I want to go ahead and put my physical stop right below the 20. Okay, but if you do that, then you're not following the one strategy, which is fine, because everybody's got to go and look at this themselves. I'm showing what I'm doing, and then you can go ahead and formulate your plans based on your registered financial representative and your risk trading plan. Can't emphasize that enough. I always say it, but people need to actually listen and hear that. So what I'm saying is that we're going and moving the stop up, or we're just, even if the stop is down below, we're going ahead and canceling out of that trade and closing the position if it closes down below, even if your stop is down here. So that's a different strategy than going ahead and you just blindly moving your stop up down below, because as you pointed out, you will get stopped out if it turns around. It could be a perfectly good trade back to the upside. It could have a nice key reversal up on this trade, but you won't be in it because you'll have been stopped out. But, like I said, that's not necessarily a bad strategy. It's something people need to evaluate. Were you expecting it just to take off the next bar and it's all of a sudden going and taking a bigger dip than you thought? So it's to each their own, as far as their comfort level. Okay, on that trade, on that kind of trade. So just understand that, know that, and but I'm showing it the way I'm looking at it here, which is I have right now an initial stop set of 8 ticks. Okay, but if it closes below that 20-period moving average, even if it hasn't reached 8 ticks, I'm going to be looking at exiting that trade. I said the only variation of that would be if the hourly happens to be within half a point or so of that, close enough that I feel there's enough support for one more bounce to maybe scale out break even or something like that. Normally, though, for me, this is how I'm going to be looking at doing my exits. Not this way here. Okay, so I should actually say not this way here. Tom, that's a question I've addressed actually in the past when I've shown this, leading up to this. And the short answer is you have to, the question is what is far above and what is far below, and would you still take that trade? For instance, as you know and you've seen here, my usual comfort level is usually no more than 2 to 3 points away from like the 20-period moving average. If the speed lines are, Tom's question is, if the speed lines are far above or below the 20-period moving average, would you take the trade? And as I've said all along in here, we have the situation where we've got the speed lines. These are, well, that's okay. We'll even do it this way. Where the fast speed line is up here, let's say at, right now we're trading at 1029, so let's just go with that, 1029. Okay, then let's say the slower speed line is at 1027, and the 20-period moving average is down here at, well, let's call it 1026. That's a 3-point spread, Tom, down to my trade. I usually don't feel comfortable. Well, frankly, I lose my comfort level. It slides off dramatically after 2 to 3 points. So that's why I've always said that I'm going ahead and typically looking for tighter spreads. Ideally, 4 to 6 ticks or so is much more ideal. Where you got between the 20 and your entry price, but up to about 2. Okay, so going back to what I was saying here was the what I'm going to be focusing on for my exits, okay, in this trade is going to be right here and here. Okay, so let's review these. Moving the stop to break even or plus 1 tick as soon as the trade moves 2 to 3 ticks in my intended direction. Now you saw me do that last Friday, pre-holiday trade. The market moved 3/4 of a point in my direction. My target, because of the resistance level that we were in the middle of at that time, you recall we were almost in the middle of a resistance level, so my target was about 1 point away from the entry. So after it got up to 3 ticks there, I went ahead and I moved my stop up to +1 tick. Well, bottom line is, of course, right after that, it actually took me out of the trade for the entire profit of 4 ticks. Okay, but nonetheless, you got to see me, and so for those of you that don't remember that or didn't look at the video, go back, watch last Friday's. I believe it was Friday morning's video. We went ahead and did just that. Okay, and so looking at moving it up to +1 tick after you get some profit in there so that you don't turn a winning trade into a loser. Now, a more aggressive strategy would be to go ahead and keep your stops wider and only move this up. And again, this is something you have to feel comfortable with in your risk trading plan. But a more aggressive version of this, and what some people here are more comfortable with, is keeping the stop wider and only move it up to, let's say, -2 or break-even level if maybe we've gotten through several minutes of trade. So basically, several minutes of trade have passed without any sort of result in your direction. So what you expect to have happen doesn't, is what it boils down to. Then maybe you'll look at tightening your stop. Or if you've begun scaling out at, let's say, +4 ticks or so, then you may want to go ahead and once you've got, let's say, that first point under your belt, you take a little bit off the table. So then you move the rest of it to -2 ticks so that no matter what, you're going to go ahead then and take a loss or break even on the remaining after those first 4 ticks. So it gets up in your direction. This is pretty much what you guys saw me do back earlier this year with the live trade room when I was doing some of those trend trades. It moved up 4 ticks in my direction. I took some off the table. Okay. And then it went ahead and moved up to 8 ticks. Well, after it moved up to 4 ticks, I think I moved up to around break even or +1 tick. Then it moved up to 8 ticks. I took a little bit more off the table, moved my stop up to +1 point, and then when it moved out to like 12 ticks, I exited the rest of the position. Okay, so what I was using was kind of those increments. When I got to 8 ticks, I moved up to 4 ticks. Okay, when I got to 4 ticks, I moved up here, to break even +1 tick. There's certainly many different ways to go ahead and do it. Is there any one is there any particular way that's right versus wrong? Well, no, I don't think so. Completely, as long as your stops aren't too tight, you give your trade a chance to work. But at the same time, you don't want to turn a winner into a loser. And we can debate this all day, because what I find is most junior traders go ahead and they look at this with hindsight. And I've had some fun with this in the past. For those of you that were in the room earlier this year, you'll recall when I actually did this, I had group participation in my trade. I'm like, okay, gang, I'm up 4 ticks. Now what do you think I should do? Tim, you recall that? Okay, I'm up 8 ticks now. What should I do? And people were freaking out left and right. People, I should go back and pull that video up and show it. There are some people who are like, just dump it, just dump it. It was fun. And I'm like, no, because in the end, I'm going to manage the trade the way I want to. I'm like, no, I'm not going to dump it here. I'm going to tighten up my stop and keep letting it run. Take some off the table and let it run. So it was very interesting to see the different traders, with different personalities. And some people, of course, don't move your stops. Basically just let this thing run until it turns around and you eventually start losing money, which, I mean, at some point you got to exit. It's kind of weird to see the different personalities at work. It's like, well, when do you eventually want to take the profit on it? But everybody's got different opinions on this, okay? So is there any right or wrong answer conclusively on it? Well, I'm not going to go ahead and say that there is, but I'm going to show you what I'm doing, and it's going to fall into these 2 categories here, where depending on the nature of the stops, like for instance, the -2 level. Well, if I feel that I've got real strong support at break even, then I may keep it looser like this. If I feel that my support is right near my trade, and so that if I start letting this go too far against that position, and I could turn a winner into a loser, then might stick more with this strategy. Either way, as we've seen these trades these last couple of days, live and in person here, they have the opportunity to make money. So even with a handful of contracts, there's some good money to go ahead and be made with them. Last Friday's trade, for instance, was just only 5 contracts for a point, so it's $250. Yesterday, as you saw, I went ahead and had the opportunity. I was up around $750 or $1,000, but I moved my stop up, and so it actually ended up taking me out of the trade for $250 versus the $1,000. So there you get to see, okay, both sides of the coin, both sides of the argument. Either way, I made money both times. Which, like I said, that's far better than many traders do. So you can see the pros and the cons of keeping things tight or going ahead and letting them a little looser. But generally, my strategy, as you'll see with this, will fall into this, not this. Okay, but that's me personally. Okay, if you do this, I'm certainly not going to hold it against anybody that does this. I'm just letting it's just more conservative. It's a little bit more advanced, and I recognize that for people that are newer to this, especially moving stops up or down. Of course, if we're talking about a push down. So some people don't feel comfortable moving those things around. Okay, or they're not familiar with their platform enough, and that's why I said we can demonstrate that here. Okay. All right, so with that said, I'm going to go ahead and what we're going to do for just a moment is it's actually, we've been going for about an hour here, and I've learned from the past with these webinars that these, especially with me doing all this talking here, I need a quick break. I know many of you. Okay, Tim, very good. Why don't you go ahead and take a bio break there, and for everybody, why don't you use this as a quick opportunity, and we'll start back up here in about 5 minutes. Okay, gang, I have not begun discussing this one. I'm just going ahead and putting it up there, and we'll talk about it here in just a few minutes. Okay, gang, we're going to go ahead and get started here. Two things. First of all, Mark, hey, no problem about being late. Completely understand. Glad you're here now. And second of all, in regards to you, Chris, no, these techniques were actually developed, and I kind of demonstrated variations of them here to Greg, I believe it was in the past. It was somebody I was showing some of my equity. They were asking me to look at some equities for them, and I'd previously demonstrated this, along those lines back actually months ago. So these have been around for a long time. With the volatility, though, that we had, I chose to go ahead and stick with the like the thrust pullback thrust, because I was looking at the thrust pullback thrust as being more suitable in the middle of the volatility, where we would get what we were having happen more so earlier, if you recall, Chris, this year quite a bit. When you're sitting there, and even yesterday for a little while we had it. So let me pull up yesterday's chart. Okay, this is the 5-minute chart. Trying to get back to yesterday here. Okay, here's a couple of examples. You see where the speed lines were really right on top of each other. This was the big example that I was actually referring to. People kept trying to play breakouts here, okay? And remember, we had my all-important 1023.5, 1025.5 resistance band here, and they kept trying to play the breakouts. Well, the thing is here, see what happened at the same time, Chris, with the speed lines, okay, was that they started crisscrossing all over each other, okay? And what happens is, remember, these speed lines are effectively moving averages. So what happens is that what happens in a sideways or highly volatile market, okay? Hopefully everybody knows that moving averages go ahead and become less useful in that time. And since I saw this overall move from more smooth and steady volatility to this whipsawing volatility back and forth earlier this year, just like this kind of thing right here, I went ahead and I chose to focus more on the thrust pullback thrust type trade versus this trade. But as I've said now for the last couple of weeks, I've been preparing people. I'm seeing that, I kept saying the back half of this year I'm expecting more trend trading, and then I went ahead and saw that opportunity even more and more. More people have been in this room commenting on the same thing, that as we're getting ready to go ahead and resolve itself,